Hey everybody, welcome back to the Economic Analyst channel. So the month of January has pretty much closed out now. And as we move into February, I'm going to give you kind of a state of affairs of where our investment markets are heading in the wake of the current economic situation of what's going on. So the two major forces right now that are driving investments in general has been the increasing inflation rates that we've seen from 2021 and now the coming interest rate increases. And indeed, we're already starting to see interest rates go up. The U.S. Treasury markets have already gone up. They've increased in the past month by about from about 2.7% on the rate down up to about 2.21%. And the yields on corporate bonds are also starting to increase. So, back at the end of December, the AAA corporate bonds were at 2.04. They have already risen to 2.3 and are beginning to run a little ahead of the U.S. 30-year government bond interest rates. So as these interest rates have started to climb, we're seeing a decrease. And hang on, I'll move my window here so that you can see here. We're beginning to see a decrease in stocks. Right now, this is the Dow Jones average, and year to date, the Dow Jones has dropped by 1,500 points or 4%. The S&P 500 has dropped by 6% year to date. The Wilshire 5000 has dropped nearly 7% year to date. The NASDAQ has dropped by over 10% year to date. And the big thing to note is the Russell 2000. That's dropped by 9% in the last month. And year to date, it has dropped 12%. Then Bitcoin has dropped by 13% year to date. That's another thing to note here. And even though it had a bigger drop earlier this month and is sort of recovered, but again, the driving force behind this is rising interest rates. So the rising interest rate phenomena now is taking precedent over the inflation rates, but the both are actually working together to drive the economic forces right now. And basically, what we're seeing is that gold and silver are flat here. Now, back at the end of December, I believe, I kind of made a video that talked about how we should start seeing a move into gold and silver as money would be pouring out of the stock market, out of cryptos, out of other speculative assets, out of bonds, and start moving into safe havens. Well, we're already beginning to see that happen where they are moving out of bonds, cryptos, and stocks, but they're not necessarily flowing into precious metals right quick. So the question becomes, where are they heading? And much of this is heading into the dollar. It's heading into cash and short-term instruments there because the dollar is more liquid. So this is the nominal broad U.S. dollar index. And over the past month, it's pretty much held sway. It's pretty much held sway and held stable despite the flat fact that we're having rising inflation rates. And one of the reasons why is because there's the looming increase of interest rates, which will then start yielding rewards and rewarding savers once again, especially when the Federal Reserve starts raising the Fed funds rate later on this year. But what about precious metals? Why isn't precious metals going up yet, even though I predicted? Well, there's two things. One is that the dollar has an advantage over precious metals because the dollar is a liquid instrument. Precious metals is not. It's non-liquid. It's a hard asset. When you purchase precious metals, you have to pay a premium, just like when you do stocks and you have the ask and bid price. For precious metals, you have to pay a premium for that metal, and then you sell at a discount. That difference or spread between the two is what is paid to the exchangers and the intermediaries that give you or sell you that precious metal. They make they make the profit off the spread between that premium and discount. Okay? And this is true with any type of good that we buy. When we buy good at the retailer, at the retail end, when we buy goods from Walmart or the supermarket, those prices that we pay are higher than the prices that the retailers paid for the same thing. Why? because the retailer is putting in the work and effort to be the intermediary between that wholesale final good and the retail good that we buy and consume. They're the ones that pay for the property and equipment that holds and warehouses these goods, and then the marketing and the sales to actually sell us that good. So there's a premium that is bid up on that. And the same is also true with precious metals. That's also true that when it works in reverse, we sell at a discount. But that's not the case with cash. When you exchange it for cash, you get your cash right then and there, and you can use that and exchange that cash for goods at any given time. That's something that precious metals cannot do since we've come off the gold standard. We don't have gold and silver and other precious metals as legal tender. If we did, then a lot of this liquid, non-liquid barriers would start melting away, and precious metals would already be jumping and leaping in price right now. The second thing is that there's a dimension, and it's time, okay? It takes time for these markets to adjust and for investor behaviors to adjust. For the past 20 years, really for the past 40 years, with the exception of the 10-year spread from 2001 to 2011, precious metals have not been at the forefront of the investor mindset. It has been stocks, it has been bonds. That's been the plays. If you bought bonds in the 1980s, you would have made a fortune. If you bought stocks in the 1980s, you would have made a fortune. If you bought gold in the 1980s, you would have suffered a loss for some time, then you would have made money back. But regardless of which, you would not have made as much money as if you bought stocks and bonds. And that does not count. That doesn't count for stocks, at least. It doesn't count the dividend payments you would have received for owning stocks. And now cryptos are the play because they're a speculative asset. But the tides are changing. With inflation increasing and interest rates moving up, this interest rate phenomena is the first time that we've seen this in 40 years, okay? So when we take a look at corporate bonds, and we go back all the way to the 1990s, okay? Look how the corporate bond market has been in a steady decline since the 1990s, okay? That's the result of what's been going on with low interest rates policies from the Fed. But if I put in the 10-year Treasury at constant maturity, and we take a look at what the 10-year Treasury has done since the 1980s, the interest rates have come down after they peaked in 1981. When interest rates come down on a bond, the bond's price increases. You actually make a profit off the bond if you were to sell it, because now you can sell your bond that is trading at a relatively higher interest rate than other bonds on the market, and you can sell your bond at a higher price and pocket the difference for a profit. That's the advantage that's been going on, and this has been drilled in the U.S. investor mindset for 40 years. It's only become a recent phenomena that gold and silver are the plays. Now, we did see the run up in the gold and silver markets in the 2000s, and I would like to bring up the gold and silver prices, but I can no longer do that on the Federal Reserve Education Database. The data has been removed. For whatever reason, I do not know, but I no longer have access to that. But if we were to take a look at what's been going on with gold and take a look at all of its data, gold went through a huge surge during the 1970s, and then it went through a 20-year bear market. Now, it's gone through a huge surge all the way to about 2011, but discounting the run-up in 2020, it's pretty much just been flat. Gold is about where it was 10 years ago. So if you bought in 2011 and you own gold now, you really haven't made any nominal wealth. And that's something that investors are going to look at. Eventually, though, as interest rates continue to move up, dollars will be accumulated, but so will precious metals as long as inflation continues to increase, because what's going to counter the dollar move is the inflation rates either stay where they are or maybe slightly drop but still stay elevated, say over 5, if the CPI stays over 5% year over year. then even if the Federal Reserve were to raise interest rates from 0.25% to 1%, you're still losing money by holding dollars. And eventually investors are going to get tired of this, and they will change those dollars out to precious metals. So the flows are coming out of bonds, cryptos, and stocks, and they're running into the dollar. The next up on the market is precious metals. And there's actually another category in here, and I'm going to go ahead and put it in, and that's commodities. Commodities will also go up with inflation rates. But again, just like with any other type of hard asset, even though they're going to go up with the inflation rates, the counterary force is if the interest rates move up. The interest rates moving up increases the opportunity cost to holding stocks, to holding commodities, and that will put a downward pressure on those commodities. I don't think that's going to transpire with precious metals because, again, precious metals will be the final safe haven value. The interest rates moving up on an economic situation would be normally push down precious metals. But because of the nature of why interest rates are moving up, aka to counter inflation, it will probably push up metals too. And it may actually push up commodities too as investors flock to hoard them, as well as exchange their dollars for consumer goods, which is what's driving up the consumer price inflation. Now, I can't say for certain whether that's going to transpire or not, but the play right now has been that essentially precious metals have retained their value over the last 30 days. Now, this is a very short time horizon, so it's yet to be seen whether stocks will recover. But the most speculative areas of our investment markets, cryptos and small cap stocks, they're taking the brunt of the hit right now, okay? And the NASDAQ 100 is right behind it because tech stocks are very interest rate sensitive. When we take a look at the aggregate stock market, it's dropped by 7% because that encompasses small cap and large cap stocks. Large cap stocks have fared a little bit better, and especially those industrial stocks. But no matter what, owning the stocks now are actually losing value, not gaining value. Gold and silver right now remaining flat is at least retaining value. Now, there's one other point that I need to mention about what precious metals will do during a rising interest rate environment. There are two situations that can develop within a rising interest rate environment that would cause the outflows out of bonds, speculative investments, and stocks. In a normal situation, if interest rates are moving up, this would also put downward pressure on precious metals and commodities on a nominal standpoint, okay? So in other words, as prices drop of everything else, so will the prices drop of precious metals and commodities, and the dollar will increase. But the reason why precious metals, I believe, are going to push up, and probably commodities as well, is because of the rising inflation rate. The interest rates now are chasing the inflation rate, okay? The inflation rate, the interest rates on a real term basis are still negative. And as long as they remain negative, I believe this is very bullish for precious metals and commodities. But the rising interest rate aspects will be negative for bonds, cryptos, and stocks. Why? Because all three asset categories have been heavily overvalued. That's my thinking behind this. We'll see how this transpires. But my guess is that we're probably not going to see the push into precious metals into probably, say, after March. And the reason why I say that is because that's when the Federal Reserve is going to raise its Fed funds rate, okay? And if we take a look at what happens when the Federal Reserve has hiked interest rates in the past, we can see that there's a correlation a lot of times, especially during a rising inflation environment, between that and gold. One of the things was that gold appreciated very strongly from the early 1970s to 1974, and then gold did appreciated very strongly from 78 to the early 80s. Now, when the Fed raised interest rates in the year 2000, that also signaled the bottoming out for gold, and gold's price started to run up in 2001 and so on. When the Fed raised interest rates in 2006, in 2008 and 2009, gold started having another run up in price. And sure enough, when the Fed started raising interest rates in 2016 and 2018, that did start creating an increase in gold. Because when we take a look at what's happened with the gold price, We see here that in the 1970s, into the mid-1970s, we saw the little run-up in gold. Then there's the run-up at the end of the 1980s. And then when the Fed hiked interest rates at the year 2000, gold had bottomed out, and we went through this huge bull market climb. And when the Fed raised rates in 2005 and 2006, there's gold's climb. It did the dip from the 2008 stock market crash, then it climbed again. So then looked at what happened when the Fed started raising rates in 2016, 2017. Gold started to climb again. What's going to happen when the Fed raises rates this time? More than likely, we're going to see the push up in gold. It's not because that the interest rates are moving up or pushing up in gold. It's rather what the interest rates are doing to these three asset classes. The deflation of the bond market, crypto markets, and stock markets is going to inflate the price of the precious metals because literally there will be very little to run to. It's going to be commodities, the dollar, and precious metals. And the dollar is going to get squeezed and hurt from the rising inflation numbers that we've been seeing in 2021 that will spill over into 2022. That's my thought on this, guys. Now, again, if the dynamics of inflation start to change, this could definitely skew or throw off my little forecast here, my little predictions. But I wanted that to sit with you on this, on where the plays are going to. And so for those who are holding precious metals, like me, I'm holding my metals. I'm not selling them. I don't think that they're going to lose money, especially not in the long run. But even in the short run, I still think that the bull market has yet to begin, and it will begin at the onset when the Fed starts hiking rates later on this year. So hang tight on that, and we'll see how things play out, and I'll give you the play-by-play action. I'll probably do one of these reviews about once a month on where the market is standing right now. But the outlook that I see is that right now with rising interest rates, it's not looking pretty for crypto. So we'll probably see them drop a little bit further. It's definitely going to drop for bonds, both the corporate and government bonds, especially on the long end. And both those combinations are not going to look good for stocks. So I expect to see more of a pullback in the stock market, especially in the small cap stocks. And what you can use to gauge that would be the Russell 2000. Expect more of a pullback on the Russell 2000 and then the NASDAQ following right behind it, as well as the Wilshire 5000. And then begrudgingly, large cap stocks will start to follow suit on that. And the more that those drop, the more that there remains of cash available to buy precious metals. So you could look at the buildup in the dollar that's been going on in cash assets as sort of a potential energy that to transfer into precious metals. The only thing that the investors are waiting on is the dawning realization that these instabilities in the economy are going to last longer than what they expect. And when that sets in, the flight to precious metals will begin, and then we'll start the bull market in gold and silver. Guys, as always, thank you for watching this video. If you like my content, if you like the videos that I produce and the content that I'm providing to you, make sure you just click that like button, subscribe to my channel, click that notification bell, and as always, I'll talk to you next time.